Hey there, Addy here from heyaddy.com and buildingsforsaletoronto.com. One of the questions that I get a lot from buyers is how do we evaluate properties, investment properties that are coming up for sale? As you might know, some of the properties that are coming up for sale, they don't have any prices on them. So you actually have to do an analysis and come up with the price that you're going to be making an offer on. So there's different ways of doing it. I have a model set up which I use whenever I am reviewing a property. Here's an example of one. I have taken all the names and all the addresses out, but this is an actual property that is available for sale right now. And what we're going to do is quickly run through the numbers just to give you an overview of what an analysis looks like. Again, this is by no means a definitive answer on what the price should be. It all depends on what your underwriting is and what your criteria is. If you are somebody that is looking for more cash flow from a property, your price is going to be different than somebody who is looking for overall appreciation of an asset and is looking at it more of a value add play. So depending on what your underwriting is, your numbers will be different. So if you are interested in talking more about this or want to find out what type of assets actually meet your requirement, let's get together. Let's have a conversation. You can reach me at 877-439-2339, or you can email me addy@heyaddy.com. So let's look at this one. So this is a 41 unit building. It's located in Mississauga, and it's got 31,000 square feet. Average unit size is 778 square feet. So all this information is filled out over here. There's 46 parkings over there. The seller is asking $12,500,000 for this asset. When we're doing any review, one of the first things I ask for is a copy of the rent roll. In Ontario, we are in a rent-controlled environment, so I like to know how long the tenants have been there and how many units are being turned over on a per-year basis. You don't always get that information, but whatever you get, you basically take that information and you put it in a nice little rent roll. So in a spreadsheet to lay out your rent roll. So this gives you an idea as to the rent roll should have like a unit number, the name of the tenant, if it's vacant or occupied, what they're currently paying, the unit type. And one thing that I like to ask for is a move-in date, but you don't get it all the time. But in this case, you don't have it available. I don't know what the date of the rent roll was either, so that's a big question mark for me too. So we tally up the information. So this is a 2-bedroom, currently paying $1,056. Market rent for that unit is $2,300. How do we come up with $2,300? You can take a look at different sources, CoStar. You can do a market survey, a rental survey of different buildings in the area. Geographically, you can take a look at other buildings that are competing with yours and see what the market rent is and what are they charging, because your asking rent will be driven by what the competition is charging. And we tabulate that information and put it in here. So I don't have a complete copy of a rent roll survey, but there's a rent roll survey completed. And according to it, it showcased that, the location where this building is, which is in downtown Mississauga, close to the New Hamilton LRT, the rent for a 2-bedroom is around $2,300. The rent for a bachelor is around $1,675, and the rent for a 1-bedroom is $1,950. So we've input all that information. So it's giving us an idea of what the monthly rent is. Collection is $49,305, but the market rent for this same building is $86,150 on a monthly basis, which is a difference of $36,845 or 43%. So this is an important number to remember. The gap to market on this building is 43%. So whatever if you're making $100 right now per year on this asset, there's an option. There's a 43% additional value that you can unlock in this. So now we have a rent roll in there. The other thing that we ask for is past 12-month expenses. So you want to know seasonally adjusted what the property is what's expensed at the property. What are the expenses for that property? Your expenses on the very minimum should include your property taxes, your insurance, property management fee, repairs and maintenance that are required, any staff that is there. You have utilities. Utilities are a very, very big portion. And when it comes to utilities, you have heat, water, and your hydro. You have any external contracts that they have, landscaping, you have snow removal, you have elevator maintenance. All of those need to be accounted for. So the seller will provide you usually with their P&L statement that has a lot of those expenses listed. You'll have to go through and figure out which one is what. And then you also have like pest control contracts. Those all need to be accounted for. So all of those expenses are incorporated, and based on the seller's information, this property has 261,737 per year in expenses. We rewrote those numbers based on our understanding of the asset and what will be required. So based on our number, it's going to be around $282,000 per year. So what does, so let me take a step back. So rent roll, we have to summarize all of this information. All of that information is summarized here. So you have 9 one-bedrooms, 24 two-bedrooms, and 8 bachelors. You have your price per square foot that is being calculated based on the information that we have included here. And then this is your market rents. Now note that the market rents over here are a little different than the market rents that are in my rent roll, because I have taken the formula out. I was playing with it. So I adjusted the numbers to $1,850, $2,150 for a 2-bedroom, and $1,550 for a bachelor, and it spit out these numbers for me. Market rent growths are added. So for Ontario for 2022, the rental increase is 1.2%. So we have incorporated that. I'm hoping that going forth for the next 9 years, we're going to see a 2% increase coming through from the Landlord and Tenant Board, and based on the Residential Tenancies Act. Inflation has been pretty crazy, and we're expecting to see some rental price increases as interest rates have gone up. And the other main important thing to note is rent increase timing. So I have it set up so that it starts from the first month and it goes to month 120. 120 is 10 years. We have a 10-year hold on this property. So once we have this information all included in here, we can take a look at our monthly cash flow. So when we're doing these analyses, we're doing it on a month-to-month basis, and then it gets consolidated into annual numbers. So as you will see, on a month-to-month basis, our gross rent is going from $49.56 to $49.877, $51.88. Now, in real life, this is not how it's going to happen. You will have an anniversary of each lease, and as each lease is renewed, it gets a bump. But to account for the timing factor, it is done here on a per month basis. So you can see that this is all in year 1, and then you get into year 2. And then you can also do a quick snapshot and see that, for year 1, our NOI is $338,855. So this is what we're going to be using in our annual cash flow. On our annual cash flow, we can see our gross rent, our vacancy that we have incorporated, bad debt, total net rent, effective rent, and there's your net operating income. Now this also takes into consideration our mortgages, there's debt, and then there's also construction. Now one more thing I should point out, because these rents are so low, these are telling me that these units have been occupied for a very, very long time. So we might be looking at doing an extensive renovation on this property, which means that we have to spend money. So we have a construction budget over here of $20,000 per unit, and we're basing it on 10% turnover. Now 10% turnover comes from this number we had. So 10 years, and it's basically turning all of the units in 10 years. So that's 10. And based on that 10% turnover, $20,000 per unit, we have a budget of $820,000 for renovating all of the suites in this unit. Going back into my summary now. So now we had the information, $12.5 million asking. It's got a going in cap rate of 2.71%. Now some of you might be saying, well, how can somebody pay such a low cap rate for a building? Well, if you look at the project level IRR for this one, this project has an 8.8% project level IRR. Mind you, this is not by any means a complete picture. There's other information that needs to be reviewed, i.e. if there's any capital budgets that are required, etc., etc. Just a quick and dirty, this one is 8.8%. So if there's a buyer out there that has that wants to invest in real estate and has a requirement that it needs to generate 8% return IRR, this project fits into it. If you look at their average cash on cash is 1.77% over the course of 10 years, which means that a big portion of that cash flow is going to be negative. And we can see that in the annual cash flow. So cash flow after debt service, you see that for 4 years, the cash flow is sitting at negative. So if there's somebody that is looking for, and the 8.8% number that we see actually incorporates these negatives into it. So if somebody's looking basically just for the IRR return, this might be a good purchase for them. The other aspect of the price, so again, so that's one is looking at the project IRR. It also has a 2.28% times equity multiplier. If you are out there and you're going to be getting a loan for this one, the lenders have qualifications for how much income an asset has to generate for them to give a loan out. If you look at here, this one has a debt service ratio of 0.81x, which means that the property is currently not covering all of its debt service. So if there is $100,000 in debt service required, or your mortgage payments are $100,000, it's only making $81,000 right now. So one way a buyer might accommodate this is they would decrease their loan to value. So if they go to 50%, now it's 0.89%. Now lenders will have specific requirements, 1.2x for a 5-year, 1.3x for a 10 years. So they might actually consider keep on going down until they get to that number that it actually makes sense for them. Okay, so at 35% loan to value and and a mortgage of 4.37, you'll be able to qualify for a mortgage on this asset. But look at your project IRR. It went from 8.8% to 7.83%. So now the same buyer would not be interested in this asset. We also notice our average cash on cash changed. So what that means is that now you have more cash flow coming in because you have less money being spent towards your debt service. Best way to do this is to have an idea about what kind of loan you can get from the lender. So usually right now in the marketplace, you're looking at anywhere between 40 to 55% loan to value. I'm going to put 55% right now. And I see that my going in debt coverage ratio is 0.81. You know what? 0.81 doesn't work. Let's drop the price. So if I drop the price to $10 million, again, that's $2.5 million off, my going in debt coverage ratio is 1.02x. Now, so my cap rate changed to 3.39%. So this is how you would play with the numbers and come up with what you should be comfortable with putting in as an offer. You will notice that the project IRR has gone up to 13.16 and your equity multiplier went up to 3.3x. So the project suddenly became much more attractive at $10 million than it was at 12.5. And that's where you're competing with other buyers on. It's all about the underwriting. How are you underwriting all of your assets to get the most money for your investors while still being competitive in the marketplace and satisfying seller expectations? Hope this was useful. If you want more information, reach out. You can call me at 1-877-439-2339, or you can email me at addy@heyaddy.com. Take care, and we will talk to you soon. Bye.